This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 102.5 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans. Or you can talk to him right now at 407-916-5400.
Well, once again, we got a lot to talk about on the program this morning, right? Government shutdown, earnings season underway, and the market continuing to do its thing. Good morning. This is Joel Garris. You're listening to Dollars and Cents here on News Radio 102.5 WFLA. The numbers to call on in and be a part of the program. After all, we are sitting here live. I'm going to pinch myself. Okay, yep, I'm live. And you can engage in a conversation with us at any point in time during the next hour simply by calling 407-916-5400 or toll free 1-855-545-1025. Or if you'd like to remain, I guess, somewhat anonymous, then you could send us an email. That email is my first name, Joel, Joel, and it just simply is NelsonFinancialPlanning.com. Nelson Financial Planning, of course, being the entity, the business that we go about Monday through Friday. Of course, today is Sunday, which means that we're sitting here in the studios in Maitland and chatting with you all. So I got to start with a joke. Okay, so if you're paying attention, and hopefully you are, the markets continue to have a great start to the year 2018. Another week, another milestone, if you will, up. Markets overall were up 1%, but in particular, this week there was a particularly strong day, which was on I think it was Tuesday or maybe Wednesday. It was Wednesday, yes. And so the markets moved up. The Dow moved up over 300 points on that particular day. And almost immediately after the market closed, we got an email from a good friend and client. And it is kind of funny. I'm going to try and share it with you because I laughed out loud when I saw it, or LOL for our younger listeners. It was a snapshot off of the internet of the Dow Jones Industrial Average number, and okay, it was up, highlighting up 322 points, and it here's the funny part. So it was a picture of that. And it said, "Dear Mr. President, could you please say blank hole," I clean it up, it's a Sunday morning, "a couple more times? It seems to work really well." Look, the reality is, I think Washington is becoming even more isolated and removed from what's going on Main Street and in the economy and in the global economy, that it really turns into somewhat of a big yawn. Case in point, of course, now the government is shut down. So, when you hear that, you think, man, maybe that means the government will spend less money because, if they're shut down, then they're not spending any money. Well, here's the here's the reality of it. It doesn't actually work out that way because in past times when there's been government shutdown, the employees get paid retroactively. How's that for you, right? And that got a little problem with that, right? So the government shuts down because it can't get its act together. But basically, if prior occurrence is precedent, it just amounts to a bunch of paid holidays for federal employees. Not sure that is a good way to do it, but hey, I don't run the federal government. Anyway, there have been 18, perspective, right? There have been 18 previous government shutdowns since 1977. Okay, so help me with the math. Okay, so that's 40 years. So there's been 18 government shutdowns in a 40-year span. That's an average about once every couple of years. You know who had the most amount of shutdowns? How many? The most amount of that 18 actually occurred during who is regarded as, kind of one of the great presidents, dear Ronald Reagan. Okay, 8 of those 18 happened during his term. And if you look at the aftermath, very minimal, if any, impact on the economic data. The reality is that only a very limited part actually gets shut down. Expenditures for things like defense and interest and Social Security and Medicare and essential functions like law enforcement, those are all still working. And then, of course, anybody that was furloughed, it just winds up being paid holidays. Certainly wish as a taxpayer that there was another way around that part. So I don't go to work, and yet I'm still paid. I'm not sure. Anyway, so government shutdown, don't lose a whole lot of sleep over it. It certainly seems that in the 18 other times that it's happened, it's had minimal, if any, economic impact. What is having a big impact right now is earnings season. And what's surprising about earnings season is, look, some of this goes back to the tax cut, because here we are, okay, it's now January the 21st, and people are, I guess, officially out of holiday mode, right? And they've been out of holiday mode for probably a couple of weeks. That's given folks an opportunity to actually sit down and really work through this tax cut that happened just before the holidays. So if you remember the timing, it was just before Christmas. Christmas comes, New Year's, all that. Let's face it, the reality is you're thinking about something else. And now folks have had an opportunity to actually look at and figure out the implications of what, in fact, is going to be the effects on the earnings. And so as you're starting to hear this, what's interesting is in some of these earnings that are coming out, a lot of these CEOs are basically saying it's going to go directly to our bottom line. The tax savings is going to go directly to our bottom line. So if something goes directly to your bottom line as a business, guess what that means? It means your earnings are going up. And in fact, so far, for the companies that have announced, and we're still early in it, there's about a 12% increase in earnings, along with a 7% increase in revenue. It is earnings that are driving things, not the government shutdown. That's for sure. And as people get through the analysis on what the tax effect is going to be, I mean, you're hearing these stories, and maybe you're not hearing these stories because, far from it that the traditional media would present a positive light on anything. But you're now starting to hear these stories, right, of Apple. Apple's bringing back $250 billion of cash. Stop and think about that for just a second. $250 billion of cash. Number one, it's been sitting in cash, so it has had zero economic impact for the entire time it's been sitting outside this country. They're bringing it back, and what are they doing? They're building a new headquarters, or they're building an additional headquarters. Orlando hopefully is in the running. Hopefully Orlando gets it. Lost out on the Amazon one. But hopefully they'll learn from that and do better on the Apple one. That's a lot of cash coming back. And then you're also hearing where a company, even like Walmart, are increasing wages. I mean, you start to hear this from different companies out there, that it's going to flow to the bottom line, or they are doing things with that extra money as a way to improve their employee-employer relationships. You can't understate the positive benefits that come, particularly with the behavior that we're seeing just out of the gate with so many companies that have said, hey, we're going to bring that cash back, number one. And number two, we're going to increase what we do for our employees. And it's coming in the form of higher wages. And also, there have been a lot of announcements out there that are reversing the trend in the 401ks. A lot of employers have reduced how much they're going to contribute and match over the past few years. There's been a number of companies that have said, we're going to take some of this savings and we're going to increase the match that we do in the 401k. So there's a lot of ancillary benefits that are coming out that are just making their way into the overall economy. And yet to happen is people seeing a benefit in their paycheck. They will in about a month as those tax withholding tables get adjusted. The folks in the IRS have not yet gotten those tables complete. Those tables determine how much of your income is withheld from your paycheck. So what that means is that once these tables adjust, you're going to get about a 3% bump in your net take-home pay. Assuming all other things are equal, it's going to be about a 3% increase. That therein is going to be when the individual starts to realize the impact of these tax cuts. Corporations are now just kind of chewing through it. And that's that is a lot of the message that you're hearing during earnings seasons right now, is that they are beginning to realize how powerful this tax cut is going to be, and they are dispensing it, if you will, in a variety of ways that are pretty interesting, right? Higher earnings and higher salaries, higher wages to the employees, and greater matches on the 401k. That's a pretty good combination, in my opinion. And the individual is yet to see it, but when they start to see it, we think that it will continue to provide some additional momentum out there. Speaking of momentums, we want to tackle the markets in our next segment. Some interesting perspectives that are getting talked about there. We want to give you some perspective on it. Obviously, the market went from 25,000 on the Dow up to 26,000 within a very, very short period of time. I want to share with you some different headlines that caught our eye when it hit 25 versus when it hit 26. We'll do that here on the program Dollars and Cents. This is your host, Joel Garris of Nelson Financial Planning on News Radio 102.5 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 102.5 WFLA. This is your host, Joel Garris of Nelson Financial Planning. We've got a hot topic that I'm going to actually tackle in the back half of the program. And I've been struggling all week with how to talk about this topic because it's a tough one, and it deals directly with a lot of the ads and, frankly, a lot of the other radio programs that are on in Central Florida these days. And just a little troubling. And I had the opportunity, someone came into the office for the very first time and was trying to go over what they had been put into. It's just a little unfortunate, to say the least. And I'll leave it there because I've got some more strongly worded opinions that I would give privately to somebody. But, these conversations that are happening out there of how to, put your money in such a way as you're never going to lose and you're going to make 8% or you're going to participate in the market and all that, it just really got some serious heartburn on it. So we want to spend some time talking about that on the program, and hopefully I won't get too fired up on it. But before we get to that, some perspective. So 2 weeks ago, right, the Dow crossed 25,000, and we shared with you on the program, front page of the Wall Street Journal, okay, Dow crosses 25,000. Article immediately below it, okay, top half of the fold, so that's the important part of the newspaper. For those of you that who don't get a newspaper anymore, or maybe have never read a newspaper, it's the top half of the fold was always like the front page, and the top half where the big headlines were. Anyway, Dow crossed 25,000, and then right below it, top half of the fold, the article was many investors have missed the run-up. And the article went into detail of some of the stats that we've shared over the years with you all, and the fact that people post-2008 were positioned not as well as they could have been, okay? Particularly even as we go through last year, tracking the numbers year over year, so last year, right, market's going up, and the inflow into bond funds, which, by the way, if you own a bond fund, you're going to be surprised at what its year-to-date performance is, because it's probably a negative number, because interest rates have been kind of fluctuating up as the economic story is really coming to the forefront. So interest rates coming up, guess what happens? Bond prices go down. So if you look at every single, the vast majority of bond funds, you will see a little negative sign in front of the year-to-date return. That's not good. Dow hits 25,000. There's an article that then talks about the fact that a lot of people have missed the market, and the numbers are dramatic. Okay, there was during the first 9 months of 2017. Okay, there was a total inflow, net new money into bond funds of over $200 billion. $200 billion went into bond funds in the first 9 months of the year 2017. Yes, that year, last year, where the market was continually setting higher highs. People not believing what was going on economically or in the markets or anything like that. Here's what's even more staggering about that. That number, that 200 billion number, was 64% more than the same time period in the year before, 2016. Stop and think about that for just a second. You had a 64% increase into bond funds over a year where the market wasn't really doing a whole lot, 2016, during the course of a year when the market was doing much better. Those are the statistics that we've been staring at. And when the Dow hit 25,000 a couple weeks ago, an article in the Wall Street Journal that talked about the same. Now, fast forward all of 2 weeks, and the market's gone to 26,000. And all you hear about is the fact that individual investors are coming into the market. I don't know that it changes that quickly within 2 weeks. You're hearing this whole melt up conversation with, oh, now the market is melting up. I don't even know what that doesn't even make sense. But that's the term that's getting used in the financial media, to describe the move from 25 to 26. Okay, ignoring just the pure math, because the pure math, as we've pointed out, 1,000 points doesn't mean as much as it used to. Because 1,000 points when the Dow's at 25,000 is only a 4% increase. While certainly that's very good, it's not 10% or it's not 15%. It's 4%. So be careful as you look at these numbers and how they are now, just within the space of 2 weeks. Now all of a sudden it's melting up. Well, we track a metric on a regular basis, daily. I don't check it every single day, but I do check it. And what that metric follows or tracks is where money flow is going in the financial industry as a whole. And so I decided to look at it because I've been reading all this articles, looked at it on Friday, and lo and behold, previous 5 days, if you look at the top five asset classes that have gained the most amount of money over the course of the past 5 days, 3 out of the 5 were still bond funds. So I don't know where this message or this concept of melting up comes from, but it's not to the point where you're looking at investors that are getting euphoric, if you will, in terms of what's going on in the market. But that seems to be the explanation, I guess. In the media, I think the explanation is goes back to this whole, people have finally had an opportunity to look at the taxes and realize, hey, wait a minute, we're going to have more money as a company, so we're going to increase our earnings, and we're going to increase wages, and we're going to increase 401k contributions, and we're going to bring cash back that we haven't been able to get our hands on. All of which pretty good stuff that we believe drives the market much more than sort of some melt up, people participating theory, because that's not what the numbers say. Okay, vast majority still going into bond funds, 64% increase over the prior period in 2017, 64% increase over the prior period for 2016. Unfortunately, all of those net new money, the $200 billion that was net new into bond funds, experiencing a negative return. Look, very simply, as we said in the letter to our clients that we mailed out this past week, we are very different than the typical financial services firm. What makes us different is the fact that we do not overweight on the bond side of things. We don't. We have a way of doing it whereby on the stock side, we're going to be more large blue chip, so we don't have a lot of small or emerging stuff where you have to kind of offset the volatility there with more on the bond side. We stay more on the much more on the large blue chip side of things. That gives us greater maneuverability to own less on the bond side. And as I said, the sentence that I put in our letter to our clients, very simply put, we would rather have the task of managing emotions rather than subject our investors to the poor investment results that come over time from owning a bond-heavy portfolio. That's our concept. And when you look at where the dollars flow, even now still, they are still flowing much more on the bond side of things. We're going to slide to a break. We got open lines, 407-916-5400. Toll free, 1-855-545-1025. The email, joel@nelsonfinancialplanning.com. Stay tuned for this next part because I'm probably going to step on a few toes out there. So you may want to listen on in as well here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio 102.5 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. This is Joel Garris, Nelson Financial Planning. The numbers to call on in and be a part of the conversation, as Bud aptly states, but we'll state them again, 407-916-5400. Toll free, 1-855-545-1025. Or if you prefer, an email, that email, joel@nelsonfinancialplanning.com. So, been chewing on this topic for a while because it's not an easy topic to talk about because it runs directly contrary to many other radio programs and advertisements that are happening, not just on this channel, but really throughout the radio stations of Central Florida. And, it's funny. Back in the day when my father-in-law, Jack Nelson, first started the show 30-plus years ago, these expert series that are on the weekends, and there's a slew of them. There's garden ones, there's car ones, there's financial ones. I mean, there's real estate ones. I mean, there's a ton of them. It used to be back in those days where, it was an honor. It really was to be able to have a show on air. There was actually a vetting process that you would go through because they wouldn't just stick anybody on the air. And I guess what's changed is that nowadays, if you commit to a certain level of advertising, you can have your own show, which basically means, you commit to a certain level of expenditures on the dollars, and you can have a quote unquote expert show. And so as with so many things, right, out there in the world at large, the expertise or the information has really gotten diluted over the years because there is not really any barriers to be able to sit in front of a microphone and be able to give your thoughts and opinions. And I have trouble with that, particularly when you start to look at some of the conversations out there that are from firms that position themselves as full service financial advisory firms. That's not my words. That's directly from one of the websites, because I decided to kind of look at some of these websites. And because what got me going on this was we had somebody come into the office that had dealt with one of these places, and their money had been put in something. It was basically a viatical type of settlement that where it had just gone completely bust. I mean, it was just a complete disaster. Okay, but even the one that you could argue it wasn't a disaster was an annuity that always had a surrender charge, meaning he could never get his money back. The only way he could get his money out is if he decided to elect to have it trickled out to him by the insurance company over the rest of his lifetime. That was it. That was the only option. I mean, the money had gotten locked down with a huge surrender charge that he was not told would last forever. And at the end of the day, the promised rate of return had nothing to do with his money. And we've talked about this in programs in the past. But please understand that when you hear about these products, there's really two different things going on, two different values, if you will. There's the traditional value of your money, which is obviously the thing that people think about when they hear about returns and things like that. But these promises and these advertisements don't really have anything to do with that account value. It's almost like there is a dual value system going on these annuities or on these promises of, well, you're always going to make money and you're never going to lose money, and isn't that great? Until you realize how much you're losing to inflation and how much you're losing of your money and you're never getting it back. And then mysteriously you're never told that these products are the highest commission products in the business because you're always just told, well, don't worry about it. You don't have to pay it. Well, guess what? You do, because it's part of the contract, which is why your money is locked up and the underlying fees and expenses are so enormous on these products. If you think that somebody is getting paid without you paying for it, okay, think again. The other part of this, so there's two different values going on. There's the value, as you would traditionally think of the value, and then there's the insurance company value that you're never, ever, ever, ever going to be able to get your hands on. The only way you ever get that is if you decide to turn on an income stream, which then trickles out this pie in the sky number to you. That's how these things work. Here's the real indigestion that I have. Okay, so yesterday, and maybe I'm mad about this. I'm mad about this, I guess, for two reasons. Number one, I had the conversation with the folks this past week showing me this stuff, and there isn't really a solution. I mean, once it's locked in, folks. I mean, there's not a great answer other than, I'm sorry that you wound up stuck with this thing. Look at what the income options are, and maybe at least do that so that you can at least get some of your money. Okay, I mean, the answers aren't great because there aren't any, because it's locked in, big surrender charges. So that set me off, and then Saturday, I spent the day filing 5 different reports, which is something I have to do every 3 months, with FINRA, Financial Industry Regulatory Authority, and similarly, this past week we had our auditor in who will be filing our annual audited financials with the SEC, and so I'm spending the whole day, kind of doing all this regulatory stuff, and it really got me thinking about some of the conversations that happen. In some of these other programs. And when you look at how they describe or position themselves, they describe themselves as full service. They describe themselves as financial advisory firms or financial planning firms or whatever they describe it. But they give the illusion that somehow they can, in fact, have the universe of investment options available to you. And the reality is they can't. So the question you need to be asking, if you're having a conversation, if you're looking through your options, the first question you need to ask anybody is, if I wanted to invest my money in a pure investment, could I do it with you? And watch the hemming and the hawing. Because the reality is, they don't have the licenses or the regulatory oversight to be able to offer you all of the options. So if they can't offer you all of the investment options that are available out there, ranging from annuities to mutual funds to stock investments to bond, if they can't offer you all of those options, how good is that advice? I'm not sure it's very good, right? I want to wrap this topic up. I'm trying not to get too fired up here on the program because it's Sunday morning and everybody moves slowly on a Sunday. But I want to read a couple of more things on some of these things. Just bottom line. We're going to have a bottom line, but you're going to have to stay tuned through the break on that. We've got a number one bottom line, the question that you really need to be focusing on when you're having these conversations. And we'll talk about that here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 102.5 WFLA.
This is Bud Hedinger. You can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 102.5 WFLA. This is Joel Garris of Nelson Financial Planning. On the program today, I've covered a lot of territory, as we always do. A little conversation about the government shutdown here earlier in the program. 18 other times it's happened. The economic data during those 18 other times is not that big of an issue. Okay. The reality is, what's crazy is in the other times, okay, federal workers get paid. They're treated as paid vacation days, if you can believe that. I got a little problem with that philosophically, but hey, that's how the federal government rolls. Also talked a little bit about the transition of the market, 25,000 versus 26,000. At 25,000, the articles were all about how the average investor was not participating. Certainly the data strongly suggests that. A 64% increase in 2017 in the amount of money going into bond funds over the year 2016. That's a pretty terrible trend, especially in light of what you're seeing so far this year as interest rates, particularly the U.S. Treasury, that interest is percolating up, which means the principal's going down. And so bond funds that everybody thinks never lose money are, in fact, negative on a year-to-date basis. Now, fast forward 26,000, and you get this whole explanation that there's a market melt-up and everybody's participating, yada, yada, yada. Not sure about that. I think the story is really more about earnings and the tax cut and some of the things that you're seeing companies start to announce in terms of expected movement on the bottom line and bringing cash back. Yet to occur is the effect on paychecks, because the tax withholding tables have not been adjusted yet, and but will be in about another month or so. So folks are going to see a net improvement in their take-home pay. Lastly is the topic that we're tackling. It's not an easy topic here on during this back half of the show. And what it really comes down to is, number one, be careful about what you hear, because the reality is that if it sounds too good to be true, yeah, it is. Okay. And the question you should be asking yourself when you're going and interviewing somebody, particularly one of these, guaranteed, and you don't lose money, and you make 8% and all that, is ask the question, okay? If you're really going to provide unbiased, truthful advice, you sort of have to be able to offer the range of investments, right? I mean, would that make sense? Especially if you're going to visit somebody that holds himself out as a full-service financial advisory or full-service financial planning firm, whatever they're calling themselves, but their full service suggests that, that they've got access to everything. And then you read the fine print, and you wouldn't necessarily know this, but they're not. They're not really subject to any level of regulation, as opposed to a real financial firm like us that, yesterday I had to file 5 different stupid reports with my regulators, and I have to do that on a quarterly basis. It's all financial. That's how they monitor and make sure that we're doing what we're supposed to be doing. And then you read some of the fine print. You got to search around on the websites, but you read the fine print, and I'm just going to read what one of it says. One of them, says in the fine print, is not an investment advisory firm, is not registered with or supervised by the U.S. Securities and Exchange Commission or any state securities regulatory office. If you read that on the fine print of the website of somebody you're going to go see, I would suggest that you kind of maybe stop for a minute and scratch your head and say, if they're not subject to any level of regulation from anybody, how do I know that I'm getting the best possible advice that has the broadest scope? Or, in fact, is it always going to be an insurance product? Something to think about. Bottom line, be careful on it. If it sounds too good to be true, it probably is. So, something certainly to think about. The question you want to be asking is, who, when you go and interview somebody, ask the question, so who regulates you? And how often do they take a look at what's going on? Because the reality is that if they don't, and they're not, and the fine print on their website says that, then maybe you want to stay clear of that garbage. Just a thought. Particularly fired up given the conversation I had with somebody this past week, and the various reports that we have to file on a regular basis. Maybe I'm just mad that I had to work on a Saturday. I don't know. Anyway, next week on the program, we're going to be talking about some of the changes for 2018 involving Social Security and Medicare. So don't miss that one. Because we'll be talking at length about a lot of different things that are coming into play here in 2018 for Social Security and Medicare. Also going to be talking about a change in the kiddie tax. And that is something that you don't hear much about, but there was a change in the new tax law about the kiddie tax. So we will be talking about those two topics on the program next Sunday. So stay tuned for that. If you want to hear this program again, of course, we'll post it up on the various social media and our website tomorrow. So keep an eye out for that. Lastly, and most importantly, go Pats. This has been the show. Thanks for listening here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 102.5 WFLA.
This is Bud Hettinger. And you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.
How have your investments performed over the past 5 years? Do you know? Are you happy with that number? At Nelson Financial Planning, we've been achieving investment results over the past 30 years using actively managed investments that we own personally. This is Joel Garris, and I invite you to review your investment results with us. Visit nelsonfinancialplanning.com or call us today at 407-629-6477 to set up a conversation to review your investment performance. That's nelsonfinancialplanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC at FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 102.5 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.